We start today's market talk. You see, Trump was at Davos, and there was so much of talking which was going on, and so much of policy announcements were there. But the core objective of all of them, whether it is US, China, etc., is same, right? It hasn't changed. Accumulate capital, gaining competitive advantage, and they are now pursuing this more openly through state power and geopolitical strategy right now. So this is the basic thing that maneuver your positions to advantage, and everybody is competing for power. Now, how to navigate financial markets in the year of Donroe Doctrine? Now, Donroe Doctrine is a modification of Monroe Doctrine, which was there a long time back. Basically, US is looking to create a sphere of influence in the Western Hemisphere and South America, etc. I'll tell you why it is also being done. The takeaway for the markets from Trump's speech at Davos was his backing down from using force to acquire Greenland. So markets rejoiced for one day, but other geopolitical concerns emerged. Now people are talking about something happening in Iran, etc. So every day there is something. So what happens is why he backed down was because as we have seen in April also, moment such thing starts, then the sell America trade starts. Now what happens in a sell America trade? US dollar declines, stock market falls, treasury yields rise. Now what happens is if the treasury yields rise, US gets into problem because they have to fund their deficit, and bond prices drop. Then safe haven assets like gold and silver surge to record highs. Now, Trump responds to market reactions and then he adjusts his strategies when faced with significant pushback from financial markets, and that's what he did. Now, New World Order and the corresponding transition is far from getting priced in. This is what I wanted to highlight. It is not priced in adequately. Some of the uncertainty of geopolitical issues is getting priced in terms of precious metals rally, where you're seeing gold and silver rallying, dollar weakness and strengthening of the long-term yields. I'll show you this also, that long-term yields are going up despite rate cuts. So that is what it is getting priced in, but it is not adequately priced in terms of equity markets. And I'll show you one more aspect. A commodity bull market fueled by geopolitics appears to be in sight unless there is a sharp drop in global growth. So not only they have put tariffs. What has happened is US has set a floor price for critical minerals. It means they want to protect their producers, domestic producers, from volatility. So it protects against predatory price drops. So what China had done was we saw extreme price crashes in lithium, cobalt, and nickel in last year. So what happens is if there is no floor price, there would not be a production in the US of these critical minerals. Now, what may happen is commodity inflation would hurt downstream industries, and we saw this in terms of lower margins for polycap. And earlier, silver was just 3% of solar module cost in 2023. Now it is 20%. So that is impacting, it will hurt the industries which are using these commodities. Now, support for the rupee is thin amid uncertainty around tariffs and trade deals. So FIs at present seems to be not wanting anything to do with Indian equities, and main pressure point is US tariffs on Indian goods. Now I'll show you this thing. See, when I mentioned about Donroe Doctrine and why these commodities is important, this is Latin America's share in key commodities. So if you see all key commodities, copper, lithium, silver, iron ore, nickel, niobium, rare earths, bauxite, etc., there is a major share of Latin America in these global reserves, and Chinese are trying to get in, and this is what US is trying to create a control over these commodities there. The other issue is the level of geographical concentration of refined products has increased in recent years. So if you see here, copper, lithium, nickel, cobalt, graphite, rare earths, see how much has the concentration of refined products in terms of share of China has increased. And this is what is squeezing the US in most of the transactions with them. And this is the reason why all this issue is on. Now, talking about rupee, the basic problem is firstly we run a trade deficit. So this is the Government of India data of December 25. So if you see, considering both merchandise and services exports combined, total trade was $74 billion in exports and 81 billion dollars in imports. So net trade imbalance was $7 billion, and so this is every month if you see. So this is one of the reasons if you're running a trade deficit for the decline in the rupee. Now, so if you see the Indian rupee from May onwards, it's in a constant trend line. So if you do a Fibonacci extension, it is 93.45 etc. is a logical target, and it may go to 94.59 etc. So now this kind of technical setup is available with everybody, and everybody is doing that. And this is the reason why the equity markets are declining, though it is slightly right now overbought, but oversold. Sorry, no, sorry, overbought. That means the rupee is depreciated too much. So you may see a slight amount of strengthening now in the next few days, but the trend is this normal. So if somebody follows a Elliott wave strategy or pattern, so this is the wave one which is getting formed. Then you will have a wave two going down, and then there will be wave three going up. So the trajectory is downward. Now, once I talked about interest rates, so if you see here, Indian government bond yields, despite a lot of rate cuts, etc., are rising. So it is discounting a big threat that there would not be adequate amount of money in the budget or in terms of government revenues, and government will have to borrow more. So now, if you say, that's what I said, support for the rupee is thin amid uncertainty around tariffs and trade deals. The biggest problem is till the time this trade deal is not sorted out, the rupee will continue to depreciate. Now, investment hurdle rates for, so अब हमें करना क्या है? Investment hurdle rates for return on equity needs to be much higher than what worked during low interest regime post global financial crisis. Now, as I showed you, the bond yields are rising. So that means the low interest rate regime is not going to be there. Interest rates will have to go up, or the bond investors are asking for higher rate of interest. Despite whatever the central banks are doing, they are not accepting it. They want higher rate of interest for the risk they are taking in putting money. So that means your return on equity, expected equity, which was earlier said to be around 15% from any investment, has to be 18 to 20% for new equity positions. So you have to get into companies which are performing better. And this approach filters out companies that are only profitable due to cheap debt. So people are borrowing, and so they are profitable. But once the cost of borrowing goes up, their earnings reduce. So you have to be very clear about return on equity part of the companies which you are getting into. Now, the other problem is corporate earning growth has not matched expectations, which has made valuations look even more pricey this time. Like last week, I had covered Reliance, HDFC Bank, and ICICI Bank. There is no corporate earnings were nothing great, and that was visible in the last week where all three of the stocks have just gone down. Right, so. So the valuations are now looking expensive compared with other markets. Now coming to FIDI data, now this is interesting. So if you see here, FIs have record number of short positions in index futures, 2.28 lakh short positions, and this is on one day before expiry. Now they shorted Nifty and shorted Bank Nifty. In terms of options, see, they have sold calls and they have huge positions in puts, so they are net bearish, right? Though on last Friday they were neutral, so they have bought calls and they have sold, so they have bought puts also, so they are neutral, but overall they are bearish. Now pros, though they are long on index futures, what they did was, but they have got long, they have sold call options of index and they have bought puts, so they are strongly bearish. So if you see the positioning, FIs are bearish pros are strongly bearish on this index futures and index options. Now, clients, they are bullish on index futures, but they have strong 8.49 lakh long positions in terms of index options. So what they have done, they have bought calls, they have sold puts. So imagine now 6.15 lakh put options in terms of index options they have sold. So it's an extreme position on just before expiry, and FIs have been selling constantly in terms of cash. So if you see, they have sold roughly around 35,000 crore in cash in this month itself. And on big days, it is basically the cash selling and the positioning in index options which has taken the Nifty down. Though on Friday they were neutral in terms of index options, but they did strong shorting in terms of index futures. So, and then there was a lot of cash selling also. So you have to see that also. Now coming to US. Now here again, we saw a huge amount of volatility due to Greenland geopolitics and shifting trade policies. So, but if you see here, the 10-year yield went up to 4.3, and then Trump did a taco trade, so it has come down. So, but the market is pricing in a hold for next week. Next week there is a Fed meeting also, so it is pricing in a hold there that no rate cuts would be there. So bond yields are still trending upwards, not going down in a declining interest rate environment, because people are not convinced about the risks which they are expected to take over long-term investing. Now, dollar index declined big time. Earlier it was rising, but it softened as safe haven flows into USD came in after the NATO deal was done. But the big decline which took place on in USD on Friday was also because of the decline in Japanese and European currencies also. The reason is because now the Japanese are talking about some kind of intervention, and Europe has to spend more on defense, etc. So their bond yields will go up. Governments have to borrow more, so currencies will decline, etc. So Brent crude, if you see here, there are supply risks from regional disruptions and US winter freeze, etc. So it went up around 3%. Gold is so momentum continues. It is about to reach 5,000 now, $5,000 to an ounce. So it's on a constant trajectory, and now this trajectory has gone up. But the point here is that it is overbought. So one has to be careful. Similarly, silver. See, I had given a target of 104. It reached 103.2672 on Friday. So, but it is also grossly overbought. So one has to be careful here, because now this is more of a speculative rally. Now I'll tell you why am I saying one has to be careful. See, there is something called gold silver ratio, right? So if you see here, gold silver ratio at generally this level, somewhere around below 50 or around 48 or so, at generally this level it reverses. Because right now the silver prices have moved up much more, so the gold silver ratio has fallen. Hence, it becomes a critical point, and this gold silver ratio is now oversold. So expect a reversal of silver prices. So one has to be careful and start looking to take profits now and not start buying now. So actually you should not be buying gold and silver at these levels. Whatever existing positions are, that's okay. You can continue, but it will be very volatile from here, because it is reaching that level, and these charts are seen by everyone. Now copper, please switch off your volume. Copper rebounded on Chilean strikes and US pre-tariff stockpiling. So as I told you, they're likely to put some restrictions. So copper prices are maintaining those levels. Bitcoin declined, sell-off as traders rotated from cryptos to gold and silver, so it declined. Now S&P 500 was generally equities were flat, not much rally. It recovered from the lows in the early part of the week after the tariff panics over the Europe etc. was removed. Similarly with Nasdaq and Dow Jones. Now coming to India VIX, it has risen. So as I had told you that before the budget it will always rise. So it is rising with all the kind of uncertainty, but it is still not fully pricing in the kind of volatility and the issues which are there. So let's see what happens. Now Nifty, if you see here, uh, there is a heavy selling which is taking place. So it made a sizable bearish candle on the weekly chart. So it has come down to the 50 EMA. And if you see, the support was somewhere around 24,400 last time from where the rally started. Now, this I wanted to highlight. So this is the same support at around 24,400. So if you see here, it has broken the 200 EMA. So there would be a lot of algo trades which will get initiated and people will start booking out of their Nifty positions. And if you see here, it was going up in that Elliott wave 5 wave pattern. So if you see wave 1, 2, 3, 4 and 5, and now it is reversing. So it is making that ending diagonal position. So if you see wave 1 of the ending diagonal is done, wave 2, wave 3, and wave 4. So now if this, so Tuesday and Wednesday, we will know whether this is actually an ending diagonal. So if this 24,900 level, this level breaks, which was the last low, so then this fifth leg will continue. Hence, so that should be a concern, right? So that should be a concern here. Similarly with Nifty 500, right? Similar pattern. It is also making that ending diagonal pattern. Now, ending diagonal is basically when the trend is finishing and now it is turning bearish. So one has to be careful. Now, talking about Nifty, first support should be around these levels, but maybe in immediate future, somewhere around 24,800, 24,900 should be a decent support. Beyond that, maybe of next month or something, if the news is negative, we may test this lower level. Nifty Bank, so if you see, it was the stronger part of the index which was taking everybody up, and now this rally is halting because you see, people are expecting very good results from private banks, and that has not happened. So it is coming down now, and if you see in terms of daily chart, you see there was a distribution which was taking place in Nifty Bank, up down, and now it has broken that support. So next halt should be around 58,000, and then it may go further down. So we'll have to watch out for this space because, as I had told last week, you see, HDFC Bank and ICICI Bank have corrected. So I told them if there is a weakness in ICICI Bank, the next leg of weakness will start coming in Axis Bank and SBI. And now they have started correcting more. If you see the Friday's chart, their contribution to decline of Nifty Bank was much more as compared to others. Now PSU Bank is a different beast. And if you see the earnings, PSU Bank earnings are as good, or sometimes I think I'll show you one of the banks today. They are better than private banks. So this index is in strength. The other index which is still showing some strength is Nifty IT, but it is, see, RSI is declining, but still it has not broken the support. And metals. So as expected, metals are looking strong. So these three index are where there is some kind of support. Now, defense is weakening. So, despite all the big talk about budget and all, it declined around 3.5%. So, nothing much is expected here. Midcaps corrected roughly around 4.5%. Midcap select, and small caps corrected 5.8. So, there is a broad selling which is taking place. So the point is that the outlook is bearish. So, my suggestion is better to get into cash or take hedges, because it is looking to go down, as I've shown you in terms of technical parameters. Now I'll talk about two stocks. First is Bank of Maharashtra. It stands out as a best-in-class PSU bank supported by structurally strong fundamentals and superior operating metrics. Management is confident about meeting its guidance of NIM at 3.75. Advances grew approximately 20% year-on-year in Q3, comfortably ahead of management guidance of 17%. Retail advances grew approximately 36% year-on-year, led by home loans, vehicle loans, and gold loans. Now everybody is into gold loans. Now, deposit grew 15.3% year-on-year, exceeding guidance of 14%. CASA deposits grew 16% with CASA ratio at 49.5. Now, compare this CASA ratio with CASA ratio of HDFC and ICICI Bank. They are in low 40s or in 30s. So this is low-cost deposits, right? Amazing performance from these banks. These trends position the bank for sustained profitability and superior risk-adjusted returns among peers. Management expects to sustain ROA at 1.7 to 1.9 levels over the medium term, supported by a combination of strong RAM, that is retail, agriculture, and MSME loan growth. So it's a kind of strategic shift which is taking place where banks are prioritizing lending to these three segments over traditional large-scale corporate loans, and improving asset mix with a high share of retail, gold, and MSME, and stable margins anchored by strong CASA franchise up to 50%, which ensures low-cost funding base. Earning resilience is further supported by controlled credit costs sub 1% and consistently high PCR. So they are adequately protected also on the downside. Branch-led expansion under Project 321 as part of the plan to open 1,000 branches over 5 years is expected to further deepen CASA and enhance operating leverage, reinforcing ROA sustainability at current levels. So if you see this quarter's performance, the net interest income grew around 16% year-on-year and 5% out Q-on-Q. And pre-provisioning operating profits grew around 18.8%, much better than the private banks, though those others are, and provisions declined. So it moved into profits. So profits were up around 26%. Now, if you see here, NIMs improved. Even Q on Q, the NIMs improved. Loan to deposit ratio has also gone up. So that they need cash. So that should be very, but still it is in reasonable. Credit cost has declined. So that should be very positive. Gross NPAs have also declined. Provision coverage ratio is higher, so that means they are well secured, and ROA has improved. ROE has also improved. Switch off your volume, please. So they are doing well on all parameters. Now, advances and deposits growth is good. So if you see Q3, advances have grown 19.8, deposits have grown 15.3, which is good for the bank of their size, and it is consistent. And similarly with NI growth, net interest income, and margins in a rate cutting environment, is a decent NIMs they are doing. Other PSU banks are at below 3 also in terms of NIMs. So if you see their future projections, they're expected to grow consistently and do around 7,200 crore of profit in FY27. So 7,200 crore profit in FY27. Their market cap is around 50,000 crore right now. So that is reasonable, 6-7 times PE, forward PE, which is decent. So if you see here, net interest income is supposed to grow at around 15%. Pre-operating provisioning profits are expected to grow at 20%. Return on equity is supposed to be high, but it is declining. Return on average assets is still good. So see, the point here is return on assets is 1.6. And if you see the book value, which is expected is around 48 plus, so the projected price to book is 1.3. So if the ROA is higher than the price to book, whatever it is, say even if you see the present one, ROA 1.7 and price to book is 1.6, trailing 12 months. So if the ROA is higher than the price to book, that means the stock is undervalued. So it is undervalued, and but that is there with most of the PSU banks. So NIMs are stable. Loan to deposit ratio is rising. So they will have to improve their deposit profile. So now, if you see the chart after that dilution of the equity was done, the stock has risen up, and now it is, and in the declining market also it has not corrected, so it is nicely poised. So every dip here is a buying opportunity. Anywhere 63, 64 is a good level on a bad day to get into this stock. The other stock is Tatva Chintan Pharma. Now, this company has got four segments. First is structured directing agent (SDAs). Most critical growth drivers. SDAs are high purity chemicals used as templates to create specific pore structures in zeolites. Application primarily used in automotive control, SCR catalysts for diesel engines to reduce NO2 emissions, petrochemical refining, and continuous flow chemistry. Market positions: the second largest producers of SDA for zeolites globally and largest in India. Phase transfer catalysts. These are used to facilitate reaction between ingredients that do not dissolve in the same solvent, example oil and water. They help make chemical processes faster, more efficient, and eco-friendly. Applications: widely used in manufacture of APIs, agrochemicals, flavors, and fragrances. A market position: one of the leading global producers with one of the widest product ranges in India. Then pharma and agrochemical intermediates and specialty chemicals (PASC). This segment focuses on complex chemical building blocks and niche specialty solvents. Key products include glimes, specialty solvents, application used as intermediates uh, in the life sciences industry, pharma, agro, and other industrial processes. Market position: largest producer of glimes in India and the third largest globally. And then electrolyte salts and solutions (ESS). This is a futuristic segment focused on battery and energy storage market. So they are trying to grow this. Used in supercapacitor batteries, which are essential for fast charging applications in electronics, automotives, and grid energy storage. Market position: largest producer of electrolyte salts for supercapacitors in India, and it is relatively cheaper as compared to the competitors in India. So Q3 earnings showed further signs of recovery, particularly in two segments, SDA and PSC. Revenue in SDA grew 132%, driven by volumes, while prices are stable. It expects SDA revenue growth to sustain with new customer offtake in calendar year 26 and likely demand for Euro 7 norms. PSC, the other segment, is also likely to benefit from commencement of supplies of two large agro intermediates with modest volumes, which would scale up in the next 2 years. Pharma intermediate is on course for commercialization in H2 FY27. A new intermediate for domestic import substitution has been approved by customers and may be an anchor for Jolva's expansion. They have created a Jolva plant in Dahej SEZ area in Gujarat. Electrolyte salts additive for zinc bromide batteries with application in ESS. This is energy storage systems. Demand is picking up and it's now receiving frequent orders. Volumes are scaling up. It expects this segment to contribute 7 to 8% of the total revenue in FY27, which is slightly more than possible. It believes revenue growth of 20 to 30% per annum is achievable for FY26-27, and current facility could support revenue of 850 to 900 crores in 3 years. EBITDA margin is expected to stabilize the range of 20 to 20%. In semiconductor, it has received its first plant scale production order from a customer, and batch production is expected to start in February 26. So if you see their earnings, year on year, the revenue was up 52%, gross profit was up 71.8%, EBITDA was up 261%, the EBITDA margins have nearly doubled, and net profit was up 52%. So very strong earnings in Q3 FY26. So that is not a problem. In terms of their segmental revenue, so if you see SDA and PSC, which are their largest segments, they showed good growth, though they were decline in other segments year on year. And mix wise, if you see, the SDAs and PSC is their largest segment. In terms of gross profit and EBITDA margin, so it's a constantly upward trajectory now. Gross profit margins are improving and EBITDA margins are improving. Segmental revenue wise, if you see here, SDA and PSC are expected to grow the best. overall company is expected to grow their revenue by around 28% CAGR, and these two are expected to be the leading segments. Mix-wise, over a period of time, the PASC is supposed to be growing better. So if you see the consolidated P&L, the revenue is expected to grow CAGR 27-28%, gross profit around 34%. EBITDA expected to nearly double now in the next 2 years, which is damn good. PAT is also will become at least 2.5x. So FY26, if you compare with that, and EPS is also expected to become 2.5x over FY28. So if you see FY27, they are expected to do around 32, but after the last results, even 30 should be good. So at 30 times, so if you see here, and post the earnings, the stock went up and then it has corrected nearly 20%. So that is the beauty. The reason, and it is now somewhere slightly reaching oversold zones. So it has corrected and come below the 200 EMA. So interestingly, there is a overreaction in booking profits on uh, results which are there. Plus, there is some issues regarding cash flows and other issues, but not that much. There is small decline in their expected earnings, etc. So, but even if they do around 29-30 rupees in FY27, add around 30-35 times, so somewhere around 1,000 should be a very good entry where there is some support also for this stock. So if this fall continues, so that should be a great opportunity to get into this stock. So I finished. We'll take questions now.